So in the last video, we left off with a situation about of a student depositing $100 into a bank, and that bank loaning that money out, and then how money is being created because of this process. And we're going to continue this example here. So, total bank reserves in our example, when a student deposited that $100. That $100 created what we call reserves in the bank. Banks can loan out reserves. So to a bank, this is an asset, right? This is something they could use to make money. So this is what I want you to understand is when cash is deposited into the bank, that cash is converted into reserves, and reserves in a bank can be loaned out. So bank reserves are assets held by the bank to fulfill its deposit obligations. Now, if this bank is the only bank in town, we call it a one bank system. When campus radio uses the loan, the proceeds of the loan are redeposited into the bank. So in other words, the student deposits the money. The bank loans out those reserves to campus radio. Campus radio uses this money and spends it. Now, they give this money to somebody. Let's say they buy an antenna for their radio station. Well, the antenna company will take that money and they'll deposit it back into the bank. And this is the redepositing process. Now, bank reserves are only a fraction of the total transaction deposits. In other words, the amount of money that the bank holds is smaller than the overall loans that the bank has made. Now, this is important because this is why we call our banking system a fractional reserve system. The banks only keep a fraction of as a percentage of loans. Only a fraction is covered by reserves. Now, the reserve ratio is simply the ratio of the bank's reserves to its total deposits, and we're going to be examining this in a second. And the reserve ratio is simply the bank reserves based upon the deposits, right, over total deposits. Now, the Fed, or the Federal Reserve System, requires banks to maintain a minimum reserve ratio. This is a fancy way of saying the Federal Reserve will not allow the bank to loan out all of the reserves. They've got to keep some reserves in their vault, or maybe with the Federal Reserve itself. We call these required reserves. Anything above required can be loaned out, and we call those excess reserves. So the books of the bank must always balance. That's why we call it a balance sheet, because all of the assets of the bank must belong to someone else, in this case, depositors. Now, let's look at this. Over here, you see this is a balance sheet. And here we're tracking the change in the money supply. So when that student, let me draw this for you. Hold on. So when that student, this is the student right here. I'm going to draw a little student right here. And that student had a $100 bill. That's a $100 bill. And when the student deposited into the bank, this created two registries in the balance sheet. One is a liability to the bank. Another one is an asset to the bank. Now, the deposit is a liability because the bank is obligated to pay this money to the student when he or she ever wants to withdraw the money. Now, it's also an asset because the bank can use this money to loan it out and make interest on that loan. So it's both an asset and a liability. And notice how they both balance. That's why they call this a balance sheet. Now, when the student deposited the money supply dropped by $100 in terms of the form of cash, but it increased by $100 in the form of a checking account. Therefore, there was no change in the overall money supply. So these are what we call reserves over here. Now, the bank can loan this out. Now, let's say the bank did loan it out. When it loans the money out, it loans it to, let's say, campus radio. And the bank will create a new checking account for that customer. So that loan is redeposited back into the bank. And it also shows up as an asset because campus radio owes the bank some money. So you could see how the money supply has increased by $100. $100 here in terms of this deposit, another $100 here in terms of that deposit. So the overall money supply is increased by $100. This is because the bank was able to loan out the initial deposit, and that loan was redeposited back into the bank. So if we count checking accounts as money, and the checking account increased by another $100, the money supply is increased by $100. Now, in this simplistic example, the bank loaned out all of their reserves. Now, what if the bank is not allowed to loan out all of their reserves? What if they're required to keep some reserves in the vault and only loan out a portion of it? We'll examine that in a second. So, required reserves are the minimum amount of reserves banks are required to hold in their vault or with the Federal Reserve. And the required curves is going to be the minimum reserve ratio times total deposits. The minimum reserve ratio is set by the Federal Reserve. So a minimum reserve requirement directly limits the amount. So think about this. If the Federal Reserve set a minimum reserve ratio of 100%, that means for every deposit that goes in, the bank has to keep 100% in the form of reserves. They can't loan out any money. So you could see how manipulating the reserve requirement ratio is going to affect the bank's ability to loan, which affects the bank's ability to create money. Now, if the bank has reserves above the required reserves, we call these excess reserves, and this is what the bank can loan out. The bank can loan out excess reserves. So excess reserves determines how much money the bank can loan out and ultimately how much money the bank can create. So, and excess reserves are simply total reserves minus required reserves. Anything left over, if this is a positive amount, are excess. And like I said, excess reserves are simply the reserves bank is not required to hold. And of course, they want to loan this out because they want to make this money work for them to make some money, some profit. So the creation of transaction accounts, aka checking accounts, via loans is the same thing as creating money, like we said before. As the excess reserves are loaned out again and again and again, more deposits are created, and thus more money is created. We're going to call this the money multiplier. Now let's look at this. Let's say that same student deposits $100 into the bank, and it creates a liability in the form of a deposit for the bank, but it also creates $100 worth of reserves. Now let's say we have a 20% reserve requirement ratio. In other words, for every dollar of deposits, the bank has to keep 20 cents in the vault. Well, 20% of 100 is 20, and that means these are required reserves. Now, they have a total of $100 in reserves, which means $80 must be excess reserves. Now, $20 plus $80 is $100, so the assets equal the liabilities. But this is what the bank can loan out. Let's say they do. Let's say they make a, let me erase some of these marks here. I'm sorry. Push the right button. Let's say they loan out $80 to Campus Radio. Now, so $80 is loaned out to Campus Radio, but Campus Radio redeposits that money in the bank, and they haven't spent it yet. So you could see how there was the initial deposit. Now we have another deposit. It was based upon that loan, and we have $180 in deposits now. Now remember, the bank has to keep 20% of all of their deposits in the form of requirement ratio and required reserves. So 20% times 180 is 36. Now, we know that they loaned out $80, and that's an asset to the bank. So since the two have to equal the assets and the liabilities, the remaining money must be 64 because 36 plus 64 plus 80 equals 180. And they both are equal. Now do you see the money supply has increased by $80. Now what happens when Campus Radio spends this money? When they spend this money, they're going to drain their account. So when they do that, their checking account goes to zero. Now, if that money is spent on an antenna, let's say Atlas Antenna receives $80 because they sold Campus Radio the antenna for the radio station. Well, what if Atlas Antenna deposits that money in their own bank, Eternal Savings? Well, you could see what happens to University Bank. Well, they have only $100 in deposits right now, right? 20% has to keep in the form of required reserves. They've got another asset of $80, which is the loan that Campus Radio still owes to the bank. And you could see they have zero excess reserves, assets equal liabilities. But that money, that $64, excuse me, that $80 was deposited in Atlas, in Eternal Savings. Now they have deposits of $80. Now 20% has to be kept in the form of reserves. 20% of 80 is 16. Now Eternal Savings can loan out $64. Let's say they loan it out. Well, when they loan it out to, let's say, Herman's Hardware Service. Herman's Hardware Service gets a new deposits that loan back into the bank, and so you can see they have $144 in total deposits now. 20% has to be kept in the form of reserves. That's $29. Remember, there was a loan of 64. The remaining amount must be 51, and that's 144. So we've got a total money supply of $244 so far. But more money can be loaned out because there's still some excess reserves in the system. And this process is going to continue and continue, and the money supply is going to grow and grow. It cannot grow indefinitely because you notice how in each round of lending and redepositing, the amount of excess reserves drops. So eventually this process will stop. So in a multi-bank system, deposits created by one bank invariably end up as reserves in another bank. And this process can theoretically continue until all banks have zero excess reserves. And we could simplify this process or figure out how much money will be ultimately created by looking at what we call the money multiplier. The money multiplier is simply the number of deposits that the banking system can create from $1 of excess reserves, not from $1 of deposits, $1 of excess reserves. So the money multiplier is simply 1 over the reserve requirement. Now in our previous example, the reserve requirement was 20%. So that's 1 over 0.20, which is going to equal 5. So the money multiplier is 5. The money supply can be increased, though the process of deposit creation has its limit, right? So the potential for increasing the money supply equals the excess reserves in the system times that money multiplier, and that money multiplier in this case was 5, right? Remember, excess reserves initially was $80. The money multiplier is 5, therefore the money supply can grow to $400. And we can see this going through the system, right? Loans are made out, those loans are deposited back into the system, and it continues, and ultimately the money supply is going to grow by $400. So each bank may lend an amount equal to its excess reserves, but they can't exceed that because this is set by the Federal Reserve. The banking system can increase the volume of loans by the amount of excess reserves multiplied by the money multiplier. And we could see this process step by step, right? The first deposit is for $100. Now that creates $80 in excess reserves, and that can be loaned out. When that's loaned out, $64 is the next deposit, because only 80% of that $80 can be loaned out. Now 80% of this $64 can be loaned out, and each time the loan is made and redeposited by the bank, eventually the money supply will grow from 100 eventually to 500, and the change from the start to the finish is $400. And so that gives you an idea of how banks create money. And what we're going to be doing is we're going to be looking at the Federal Reserve, how the Federal Reserve monitors and regulates this situation. And then we're going to be looking at monetary policy. How does the Federal Reserve use this money creation process to shift the aggregate demand to either to the right or to the left?